One of the top expenses in your life is taxes. And today we're going to talk about some of the best kept secrets on how to save on taxes by investing in real estate. This is the Will Frederick Podcast, where we talk about real estate, wealth building, money, and life. And my special guest today is real estate tax pro and Norton Accounting Services owner, Bob Norton. Bob's goal is to help his clients become financially free using real estate. And y'all, if y'all know me, you know how that warms my heart just saying those words. Financial freedom through real estate. Bob actually focuses on real estate investors in his CPA practice, and he's got clients in 48 states, clients with properties in 48 states, and he's been a very valuable resource to myself and many others. And so today we're going to be talking about, he actually wrote the book on tax saving secrets for real estate investors. We have a copy of the book here today. We'll be going through some of the secrets that he's learned and he explains. So thank you for being on the show today, Bob. I've really appreciated getting to know you.
Yeah. Thanks for inviting me in. This is great.
Yeah. And another cool thing that Bob and I have done before is we belong to a real estate investor mastermind group. We've actually played the game Real Estate or Cash Flow 101, which is Robert Kiyosaki's board game.
Yep.
And so it's a really fun game. I highly recommend you check it out. It's very educational. And Bob and I got to play that game together a year or so ago, huh?
Yeah. It's a lot of great concepts in that book, and it's designed to actually teach people how to become financially free.
Yeah.
So that's the goal of it.
Mm-hmm.
And everyone's a winner in that game. There are no losers in that game.
Yeah. I know. It's a fun game because you come away learning a lot.
Oh, yeah.
So, Bob, let's talk about your book and why did you write this book?
So I talk with hundreds of real estate investors a year. They all come to me with essentially the same questions. Part of saving taxes, the biggest secret is that you have to plan for it. Mm-hmm. The tax law is essentially an incentive system for how to save money with taxes, and its instructions on how to do that. Mm-hmm. So by understanding those and employing that, you're going to save the most tax. So that's what this book was about.
Yeah, and I thank God for people like you because it sounds like chewing broken glass to me to go figure out tax code stuff. But you know this stuff already.
Yeah, well, I started years ago because I was interested in real estate. Mm-hmm. I started looking up stuff saying, well, how can I do this? What's the best way to do this? I started going through all the rules and figuring them out for my own investing. And then I was talking to other CPAs that I was working with and realized they didn't know any of this stuff. Mm-hmm. So I was like, this is what I'm going to focus on then.
Yeah.
And then I went to the library in the CPA firm I was working with at the time and said, I'm just going to look up the code section that specializes on this and figure out where that is. It turns out real estate is throughout the whole tax code. Mm-hmm. So it's not a simple part to learn. You got to learn a lot of stuff. Mm-hmm. So I just started studying bits by bits. One of the things that makes me different from other tax preparers out there and CPAs is that not only am I telling you what to do with this stuff, I'm actually doing it. Because I'm a real estate investor first.
Right. Mm-hmm.
I just happen to have a CPA license.
Right. Yeah. Well, and that's really cool. And I can speak from experience because I've had several CPAs and a lot of them didn't have a clue what to do with some of the things that I handed them and some of the questions. They had to go do research and they would give me sometimes some canned answers that I could tell were not like from experience. So you come from a place of investing experience, and that's going to inform the way you practice your trade,
right?
And advise your clients as well.
Oh, it definitely does.
That's awesome. Well, so you wrote this book to kind of as a primer to help this, but I know you and I were talking earlier. There's another podcast we're going to do on the Millionaire Next Door and the Millionaire Mind. And in those books, I learned that millionaires have learned how to minimize their taxes because that is the number one expense that all of us have in our lives is taxes. That's the biggest, bigger than the mortgage we pay, bigger than our food bill. All of that stuff is taxes. So if you can kind of master how to save a little bit on taxes or a lot on taxes, then you're going to that's like a significant pay raise, right?
Oh, it is, for sure. I mean, if you think about it, a third of your income goes to pay tax.
Right.
The secret is figuring out what do I need to do to get that number down.
Yes.
And so that's one of the secrets in the book is to start your own business. Uh-huh. Now, as a real estate investor, you're essentially in business because when you buy that first rental property, you have a business. Mm-hmm. And the people that tend to fail at being landlords, those are the ones that are always cry out, I hate tenants and toilets, right? They're not treating it like a business.
Yeah.
So they just think of, it's an investment because a lot of people out there think of it as an investment. It is, but it's also a business. And if you run it like a business, you'll have better success. Mm. And part of running it like a business is figuring out what do I need to do in my business to save on taxes? How do you structure it? You know, what kind of expenses can you deduct? Mm-hmm. Yeah. You know, and that kind of stuff. And so that's what this book talks about.
So starting a business, let's go into that because, you talked about buying a piece of investment property, and there's other businesses you can start. We're going to talk about specifically investment property today. So what is the first thing you do when you endeavor, if you own it already? Let's do two scenarios. If you own something already, but you want to start this business that you haven't started yet, how do you do that? And then if you haven't owned it, you haven't bought anything yet, how do you start there?
So if you already own a business or you own rental property, you don't necessarily have to have an LLC to be in business because just owning the property itself is considered a business under the tax code.
Okay.
So that means it's an opportunity. As an employee, when you get a W-2, there are certain expenses you have in your life that you cannot deduct, but that you may use them for your job, but you're not able to deduct them under the tax code, like cell phones, internet, if you get subscriptions, different things like that, driving around your vehicle. Can't deduct it. But all of a sudden, when you have a business, guess what? Those are all now deductible. And the portion that's deductible is that portion that's business related. So the secret is, how do you define what's business related?
Right.
So I tell everybody, it's like when you go to spend something, you go to pay for something, if you can answer the question, how does this help my business? Most likely that's a business expense. You should be paying for it with your business. And so that's where it comes in. It doesn't matter if you're an Uber driver or if you're a landlord, it's the same question.
And the concept is, just to simplify it for our listeners, the concept is if you spend it as a business expense, that's not taxed income. But if you bought it as a personal, like if I go to the grocery store and buy food for my family, that is after tax dollars.
Right.
If I go and buy food for a company presentation, that is a business expense. So I can buy that food, and that's before tax dollars. So the dollar amount shrinks that I pay taxes on after it comes out of the business.
That's the concept. Yep.
Yeah. So where do I start? I mean, and you said I don't have to have an LLC to have it as a business, right? It can be on my taxes as a business without forming an LLC.
Well, in this country, you can roll out of bed and decide you're in business, and then you start doing it and trying to figure out how to bring in revenue. Now, if you have a business, but you're not making any money, but you still have expenses because you're trying to make money, then the IRS can come back after a while and say, we think you have a hobby. And in a hobby, you can't deduct your expenses. So you have to you don't necessarily have to have a business plan, but if it's taking you a while to actually get the business up and going, it'd be a good idea to have a little business plan so that if that question comes up. But with rental properties, they don't look at it the same way because we lose money the first few years that we have a rental property because we get to depreciate the building. And we get to write it off even though we haven't paid for it because the bank has bought it and we're paying the bank. So it becomes a great vehicle for sheltering all the cash flow that comes off a rental. We don't have to pay tax on that for a while. But it's a business, and the IRS expects it to lose money. Because the idea is later on you're going to sell it and you're going to make a huge gain. You're going to pay tax on that.
Right.
But there's ways to get around that as well. One of them is don't sell. But I try not to sell.
Yeah.
But you can be in business by just deciding you're in business, but then, you've got to generate revenue somehow. So the best thing to do is if you can start in the early days, start generating some revenues. That is with a rental, having some rent. Because as soon as you collect rent, you're in business and we can start writing off all sorts of stuff.
And revenue doesn't exactly equal profit because if you're writing it off depreciation-wise, you're canceling out your income.
Right.
It's still revenue, so you can show it as an income revenue, but it's not necessarily profit that you pay taxes on.
Right.
So can you explain for our listeners what depreciation is? Because I know a lot of people don't understand it. It was a long time before I understand it. I was investing in real estate for years, embarrassingly enough, without really truly understanding depreciation.
Right. Well, depreciation is where you write off an asset over time. So if you let's say you buy a building to be a landlord, you don't get to deduct that building when you buy it. So it's not
100%. I'd like to thank our title sponsor, First Access Mortgage. They are Louisiana's first choice mortgage lender for 21 years. We're really excited to be partnered with them. If you need a vacation home, a first home, a refinance, check them out. They're truly a home loan resource for you. Now, today's show sponsor is Norton Accounting Services.
Congress has recognized that, that's an investment. The land doesn't depreciate, but the building depreciates. It has to be replaced over time. Now you do it in small bits, but, replace the roof and that kind of stuff. So they say, so while you own it, it's depreciating. So it's just a way to write off your your investment.
A portion of your investment
investment every year.
So you take that as a deduction.
You get
it's like a business loss sort of every year, even though you're not really losing anything.
Right. It's an expense. So different assets have different class lives, meaning the IRS allows you to write off over a different period of time. So a residential rental is 27 and a half years. So that's a long time. Whereas if you buy furniture for a short-term rental, you can write that off the year you buy it, or it's technically 5 years, but depending on which year we're in, the tax codes are different because what Congress uses depreciation as an incentive. So right now we're in an area where we have special depreciation, which means we can depreciate a portion of the assets we purchased this year completely.
All this year, yeah.
So and those change every year. So 23 is when we're recording this, you get to do 80% of the purchase. The rest of it will be depreciated over 5 years.
And that just changed, right? Because in 22, you could do 100%. Yeah, and I've taken advantage. That's called accelerated depreciation.
Right.
And they incentivize it. The tax code is basically just a way for the government to incentivize our behaviors.
Yes.
And some people don't even realize some behaviors are incentivized. And that's where Bob can come in and say, hey, you know what the government's incentivizing right now? They're giving you tax breaks for X, Y, Z behavior. And there happen to be a lot of those incentivizations within the field of real estate.
Oh, yeah. Lots of them.
Yeah. So that's why he wrote the book. Let's keep going on it. So what about wages versus profits? I know we talked a little bit about that.
So under the tax code, rental income is considered investment income by definition of tax law. If you're a landlord and you own 20 properties and you do nothing but manage those properties, do all the repairs, you're doing all the work. So you're working 40 hours a week on your properties. That's still considered passive income, even though you're spending all your time actually working on it because it's by definition of tax, the tax law. So conversely, if you work in a job and you get a W-2, that's considered active income. If you're a plumber and you have your own business, you're considered working in that business, that's active income. With active income, you pay Social Security and Medicare taxes. Now, if you're a W-2 employee, you have that deducted out of your check, and your employer actually matches that amount and sends the tax into the government. So when you're self-employed, you get the privilege of paying both halves. That's called self-employment tax.
Wonderful.
And so you have to recognize which kind of income do you have. Now, passive income isn't subject to self-employment tax. So part of the strategy is figuring out how do I get more income in the passive column than in the active column.
Yes.
Active column is good income. You just have to realize it's higher tax. And there's strategies we can use to minimize that. One of those is we make sure we isolate, using an LLC usually, isolate all the active income in a single business. And then we elect that business to be taxed as an S Corp. So what that does is the rules around that is that if you're an S Corp owner, you have to pay yourself a reasonable salary. But what happens is, let's say that you have a business and it generates, after all your other expenses, $100,000 in income, and it's active income, and you're going to pay 15.3% tax on that because that's self-employment tax. Now you're going to pay income tax on that also. If we elect you to be an S Corp, your LLC to be taxed as an S Corp, still an LLC legally, but it's taxed as an S Corp, then we can set your salary less than that $100,000. And we would look up and see what is a reasonable salary for your profession and pick that. And let's say it's $50,000. So now you have a salary of $50,000. So you get a W-2 from your company, and then but you also get a K-1, which is the profits that come through. So you took that $100,000, you split it into wages and profits, and now you're only paying self-employment tax on $50,000, not the $100,000. And so I do this a lot with realtors.
Yeah. Well, and I've taken advantage of that before. And the interesting thing was, early on, one of my first accountants, I had a lot of depreciation losses in my real estate because I started investing in real estate before I became a realtor. So I had a snowball of like real estate losses and depreciation. So I started making active money from my real estate business. And I thought I had all these losses, but I had this big tax bill at the end of the year. And I went to my accountant and said, hey, how come I have losses? Like, how come I'm paying taxes? And she said, well, those are two different types of income. That you have active income, but you have passive losses, and those two don't offset, apparently.
Right.
And I said, I don't know that. I don't understand that. And I'm like, well, how do we make them be the same thing? And she kind of was at a loss. She didn't really know what to do. And so I fired that accountant and got some similar advice to what you're saying. And this is before I met you, but we formed a business, and I started taking active income from my real estate business that was a reasonable salary. And then I started taking passive income from my real estate business. and it was able to offset. And I saved a lot of money on taxes when I started doing that.
Right. So the strategy there is because you're in the real estate business already.
Correct. That's specifically
you're
for
also
real estate.
a real estate professional under the tax code.
Right.
And so we can mix the two, and you get the advantage of being able to take those passive losses against active. But the tax, even if you did that, say you had $100,000 worth of active income, $100,000 worth of passive losses that year, you pay no income tax, but you're still going to pay that 15.3% self-employment tax on the $100,000.
Right.
They're two different types of taxes.
Correct.
So we would have to still do the S corp thing, and that's what that CPA did for you.
Yeah, that's what we've done. And so, but let's talk a little bit more about people who aren't real estate professionals, because not everybody's going to be in that situation, right, but they do invest in real estate. You can do something similar with that, right?
Yeah. So there's under the tax code, if your income if your household income is below $150,000, then you can deduct up to $25,000 worth of passive rental losses against that.
Okay.
But once your income goes above the 150, the passive losses get suspended. They carry forward and they offset rental income in the future. Now, what's one of the secrets about passive income is in the beginning, you'll have losses due to depreciation primarily. And if you mortgage the property, you've got mortgage interest. So you've got all these expenses. And so you've got cash flow, but you're not having to pay any tax on that. But over time, your mortgage gets paid down. The depreciation sort of stays fixed, but rents continue to increase. And so it doesn't take long before you're having passive income coming off of that. And then the depreciation isn't enough to shelter it. But those passive losses that got hung up before, they come to the rescue and they keep it from being taxed for a period of time. So it's not like you're missing out on anything by having them suspended. The good news is the rental losses or the depreciation basically shelters income that you have from your rental, so you don't have to pay tax on them for a fairly long time. There's rules to be a real estate professional. One of those is you have to spend more than half your time working on your rentals versus your regular job. So if you have a W-2 job and you're not in a real estate industry that we can sort of say, well, you're technically in that. So say like you're a doctor, then, a typical full-time year, which is argued that most doctors probably work more than that, but 20,080 hours, then you would then have to spend and log and be able to prove to the IRS that you spend 2,081 hours on your real estate.
I gotcha.
And so when the IRS sees someone who is a W-2 employee or a couple, both of them have W-2s, and they claim to be real estate professionals, the IRS zeroes in on it, and that's a trigger for being audited.
Okay.
But so what we do is we try to figure out, okay, what are the parameters and how can we do this? And let's start tracking hours. Because I do have clients that are in that situation, and one of the spouses would step back and say, well, I'm only going to work part-time this year, but I'm going to spend more time on my real estate, and then the real estate professional, and then we can write all that stuff off. So that happens a lot.
So is it easier, like if you have a single income household where the husband or wife, one of them works and one of them stays at home, that person could be a dedicated real estate professional?
Yeah, because they have no earning stuff. So now to be a real estate professional, it's 750 hours.
Okay.
So there's just 14 hours a week. But if the spouse that stays at home actually spends time managing the properties and helping with the whole enterprise, and that works great.
Yeah.
But that's how a lot of my clients do it, is that, it's like one spouse doesn't have a full-time job. It's like, okay.
And they're running that active business that is your real estate business.
And they still log their time just to show in case it's questioned, but yeah, they do that. And I have a client who just did that. And I said, okay, well, you're a real estate professional. And they started, husband was a doctor, spouse was stay-at-home, homemaker or whatever. But she was interested in real estate, and she started setting up short-term rentals and other stuff. But then they also started investing in some other real estate projects with friends. And we started doing cost seg studies on those projects, which creates huge accelerated depreciation.
Yes.
And because they're a real estate professional, it goes and offsets all the income that the doctor earns. So,
yeah, and you mentioned cost seg studies. That's a cost segregation study.
Yes.
I've taken advantage of that. We mentioned that in accelerated depreciation. Explain how that works for our people.
So when you buy a building, it's made up of different components. But the HUD statement in the purchase agreement doesn't say that. It says the building and the land, right?
And the land, right.
So what you do is you hire an engineering firm, essentially, or a consulting firm, which with engineers. And they come in, they break the building down into different components.
They segregate the
and
costs.
those components have different depreciation lives, 5-year, 7-year, 15-year, and then the building is 27 and a half years. And so that's accelerating depreciation on that building anyway, because you're taking something that would otherwise be 27 and a half years, and now part of it can go 5 years, part of it can go 15 years, and then the rest of it 25. But under special depreciation, we're able to take those and create losses for that. So that's going to phase out over the next few years, but we'll still be doing cost segregation studies because that extra depreciation up front is a big benefit to anyone that invests in it. Because for the first 5 years, you have a lot of extra depreciation.
And I mean, it's literally money in your pocket. If you're going to pay $100,000 in taxes, for instance, and you can reduce that tax bill to $50,000 or that taxable income to $50,000, then that's going to be a significant savings on your taxes. Yeah. Mm-hmm. Well, and you talk about in the book, you talk about the active business as your pack animal. Right. What does that mean? Explain that term to our listeners.
So real estate investors are actually, if you have an active business, let's say that you're a plumber and you own some rentals, then you're going to be spending money to manage your rentals that are expenses you're already spending for your other business.
Yeah.
Well, you can deduct that under the other business. And because that's the higher tax business, because it's active income, you can save more on taxes.
Yeah.
But if you're just you're a real estate investor and you have a flipper organization, you're a rehabber, so you're buying properties to fix them up and sell them, but you're also keeping a few as a rental, you're going to want to separate those in two separate entities so that the IRS doesn't get confused and consider your rentals are now active, which can happen. But your cell phone, your truck expense, your home office, all that stuff is like you're doing that for your business, your active business anyway. You're also using those resources for your rentals, but they're usually not at the same ratio. It's not mainly for your active business. So therefore, you can deduct those under your active business instead of having to track and split out, it's 10% here and 15% here.
Yeah.
You just know.
You just lump it all together.
Just put it all together.
And that's all legal, right? I
Yes.
mean, you can get in trouble with it if you don't have the right tax professional helping you.
And helping you track things, right. And then there are expenses that your rentals are going to have. So you have property taxes, mortgage interest, insurance.
Right.
Those things have to be deducted for the rental itself.
The rental, right.
But the overhead of running that operation doesn't have to be.
Okay.
Now, it depends on how much, because it just depends on what it is that you have. But
so you have to have a system to track your expenses, right?
Yeah.
Do you recommend any particular system when it comes to real estate investing specifically, or?
Well, it depends on what you're doing. I mentioned several different types of softwares in the book to get people started.
Okay.
But if you're a landlord, there's a lot of very specific software out there that helps you track your rentals, income and expense. You can have portals for your tenants so they can pay automatically, all that stuff. And there's software written for that.
Yeah, reports you can run. AppFolio is one that our rental property management company uses.
AppFolio is one. Buildium is another one.
Yeah.
QuickBooks is a software that's huge out there, and you can use that for rentals, but it doesn't have any special features built into it because it's not designed to be just a landlord software.
Right.
But you can, by the QuickBooks, you can split things into you can track P&Ls by properties that way.
Yeah.
Or by business units or whatever you want to do. QuickBooks is big, but there's pluses and minuses to everything.
Sure, yeah.
So I have a lot of guys doing rehabs that are actually using spreadsheets to track their stuff. Now they're running everything through QuickBooks for a quick P&L, but to make sure that they're actually on budget, they're using spreadsheets. So that's a viable way to do it.
Excel spreadsheets are your friend. I mean, they're highly effective. We use them a lot in all of my businesses. So So one of the things you mentioned earlier about depreciation and how it kind of carries some of the wealth savings forward, even when that depreciation is delayed a little bit. Something else that I thought was really cool that we mentioned in a previous episode with Courtney Fricky about investing in real estate is long-term wealth growth. And you mentioned something earlier in this episode about the best way to save on taxes is never sell them. Because one of the cool tricks about real estate is it does grow in value, and that value is on your balance sheet, but that's not on your income statement.
Right.
So unless you sell it, that income is never quote unquote realized, I guess you could say. So you don't pay taxes. The government's not going to come say, oh, your property went up in value by $20,000. You owe us the taxes on that $20,000. Right.
Yes, right. So in the last couple of years when the property value is going up so much, I had a lot of clients that would sell some properties because they're going, well, it's worth so much. It's like I can
Yeah.
get all this money out of it. And then,
Yeah.
of course, they're paying all these taxes.
Right.
But they didn't call me first because I would have said, just get a loan. Loans aren't taxable.
That's
So
true.
you can pull your equity out and use it to buy more properties or to spend it on whatever you want, which I don't advise buying stuff just to spend money, but to buy more properties to create more cash flow.
Right.
Instead of selling it and having a one lump sum. And the other way to do that would be to do a 1031 exchange where you can basically trade a property for another property. And because you don't touch the money, it's not taxable because you're just rolling it into the next property.
Right. And actually, I've talked about 1031 exchanges for many years with my clients in real estate as a vehicle to, delay the tax. And I'm glad to say I did my first one this past year so the rules of it are, and you can correct me if I'm wrong on this, I probably will say something wrong, but you sell the property. Before you sell that property, you have to set up the 1031 exchange vehicle.
Right.
After the sale, you have 45 days to identify which property you're going to buy. And then you have 180 days total to close on it, including that 45 days. So you have 6 months to close on that property, and you can identify it within that 45 days. And the money never comes into your possession. It goes into the 1031 exchange from the closing of the property you're selling. And then you use those proceeds to purchase the next property.
Right.
And it can be with a loan and everything like that. That's all fine. And so it was really cool to be able to actually use that tool that I've talked about for years, but I've never taken advantage. And I don't sell a lot of property, like Bob said, so that's part of the reason I haven't ever done it. But it was really fun to do that.
Yeah, the key thing about 1031 is you got to set it up beforehand.
Yes.
You got to use a qualified intermediary. I've had several people call me and saying, hey, I just sold a property. I wanted to do a 1031 exchange. So-and-so gave me your name. And it's like, so you've closed on it.
Oh, no.
Yeah, it's like last week. I said, okay, well, you don't have a 1031 exchange. So now let's talk about some other strategies to minimize that. You're going to owe some tax, but there's some stuff that you could do. The other thing to remember too is that if you walk away with cash from either the closing when you sell it or the closing when you buy the replacement, you're paying tax because that's the key thing. Because a lot of people are saying, oh, I want to sell this property, but I need $50,000 in cash to do something else, but the rest of it I want to roll forward. Well, you're going to pay tax on that.
Right.
But then what I always tell people is like, before you do the 1031 exchange, let's do the calculation and find out how much tax you're going to owe if you don't do it, because it might be that's not that much money. Everyone's just so afraid of paying tax.
That's true.
That they don't think about it. Now, if you've owned the building for 30 years, you're going to have a big tax bill.
Right.
But if you've only owned it for 2 years, you're probably not going to have a big tax bill.
And a long-term capital gain is not the same as your income tax rate. I mean, it's a much lower.
You pay a lower tax rate. So I was doing a tax return for a client last night, and they sold a property. Actually, they sold 2 rentals, and then, of course, they used that money for something else, but they didn't keep those. And it turns out, because of other ways that we structured everything, they were in a lower tax bracket. So $50,000 worth of the gain they got on one property was completely tax-free because it was at the 0% capital gains rate. So there's strategies in there with looking at that. And some of that comes into play with 1031s because maybe you're only paying tax on the recapture portion. Yeah. And if you haven't depreciated it for many years, now depreciation recapture is where you got a deduction at your full tax rate when you took the depreciation, so that when you sell a property that has depreciation, you have to pay a higher tax rate on it than the capital gains tax. It's either your regular tax rate or 25%, whichever is lower. Most of the real estate investors that are working with me, because they got passive income and we can do a lot of magical stuff with depreciation, their tax brackets are really low.
Yeah.
Right? So the depreciation recapture isn't that big of a hit.
So what I want our listeners to hear and what you just said, because a lot of it got pretty technical in the weeds for this guy anyway. Yeah. I'm like detail averse. I'm very, very I can't handle it. And so I'm really glad there are people like you, Bob, in this world that know that stuff like the back of their hand. And each situation is different. So while, somebody might say, oh, a 1031, it's like the magic bullet. It solves all your problems. It really may not. You have to look at your situation, your specific goals. Like, hey, where are you trying to go from here? What are you trying to accomplish with this sale or purchase of real estate? And how is that going to affect your future in the near term and in the long term? And that's where a good tax planner can help. I think, so one of the things I learned in reading The Millionaire Next Door and The Millionaire Mind, which we're going to do a podcast on that later on and share some of those secrets that are commonalities of millionaires, but they dedicate a lot of time toward tax planning. They make that a regular habit. They have advisors they meet with regularly, And that's just a part of their mode of operations. Is that what you recommend? I think that you recommend something like that in the book, right?
Oh, certainly. Tax planning is essential to saving taxes.
Yeah.
So that means you need to be talking with your tax professional on a regular basis. So I tell all my clients is like text me or email me or call me if you're getting ready to either buy something big or sell something big. So I can, because you're just like, okay, because we'll have a short conversation. What's your goal? What you're planning on doing with this? And I'll say, okay, here are 3 things you're not thinking about.
Yeah.
That from a tax standpoint. For everyone listening, most attorneys don't understand tax law. If they're a tax attorney, they do.
Yeah.
But if they're not a tax attorney, they don't.
Yeah.
And so they'll set up something for you that's great from a legal standpoint, but it's going to maximize your tax. So you need to make sure that, or might maximize your tax. So you got to make sure that you have a conversation with your tax planner at the same time, say, hey, I'm doing this. Because they could say, well, if you do it this way, then it'll save tax. And the attorney going, oh, okay, that will be easy.
Yeah.
You know,
right. Exactly.
You know, and it's just something they weren't aware of.
It's orchestrating your team of professionals to work together toward a common goal. And it really helps to know what your goals are. So, I mean, you know, we've talked in other episodes about knowing your why, knowing why you're into real estate investing, what your goal is. And that way you can easily tell your professionals that you engage to say, hey, this is where I'm going. You show me how to get there. And I tell people all the time, if you sell a house, that's great. Everybody's, I've had clients say, oh, I've sold 5 houses in my life. I don't need your, and I'm like, well, that's great. I sold 5 houses in the last week.
Right.
So if I do it that many times, I'm going to be better. I'm going to learn a few things about it. And Bob, you're a great example of that because, I mean, I don't know if I ever really did my own taxes. I probably tried at some point, but that was the only taxes I did. How many tax returns do you think you've done?
Oh, I have thousands. I do thousands a year.
Thousands a year. So multiple, tens of thousands probably at this point. So I'm a firm believer in hiring a professional that can do the things that I don't love to do. And that if I can afford to pay somebody to do it, I buy that time whenever I can afford it. That's a personal rule I have. So what else, Bob? What other tax secrets are in this book that you'd like to share with us?
So we talked about active versus passive. So if you have a business, an active business, and you rent space or you decide, hey, I'm going to buy a building for my business because it'll save me money and it'll be an investment. Well, you're going to want to set that up in a separate LLC.
Right.
Not buy it in we need to have a conversation, but that's basically what you would do because what you can do now is you can actually rent to yourself and pay higher rents. And now you have, the income is the same, but some of it's being a deduction from your active income and income to your passive company. So you're saving that SE tax on this side and just paying regular income tax on this side. You're going to pay income tax on it anyway.
Right.
But now you're able to run it through
a different company
and make it. Yeah. And
streamline the tax situation.
Right. So that's one way you can do an income shift. The other way is if you're a rehabber and you're doing a bunch of rehabs, at some point you should start keeping some of the properties.
Yeah.
But you can also, if you start thinking longer term, and because you remember you're paying, if you're just doing short-term rehabs, you're paying self-employment tax and income tax on that. But if you can convert that to a rental before you sell it, you're only paying passive. Now you have to use multiple entities and you have to plan for this. That's where the planning part comes in. But you buy it in an entity that's going to be a rental entity. And then you can still do the rehab on it. It's just that equity you don't cash out until you sell it after you've rented it out for a period of time. You've just shifted it from the active over to the passive side.
Over to passive,
and it could be that it's so lucrative as a rental that you don't want to sell it.
Right.
So I have several clients like that. They were rehabbers, and every time I sat down with them, it was like, well, this year you pay $50,000. You're like, how can I say this? Well, if you would have kept that property and that property, I bet you it would be a great.
Yeah.
It would have sheltered everything, and then
right.
And so now I have guys that have completely shifted. They do very few rehabs, and they do all rentals. Now they still sell. They have planned, selling and different stuff, but it's there's not a definite time on it. I'm going to do it on this way.
Right. And that's what I want to stress to our listeners, that there's a million different ways to do it, and it really depends on your situation and what you want to do. And that's why I would highly recommend calling Bob and asking him his advice for your specific situation.
Right.
And that's going to be, so I'm going to put you on the spot a little bit. Do you know, like kind of off the top of your head, maybe how much you've helped save on average a real estate investor that comes to you versus how much a tax return might cost?
Oh, it's my cost is so minimal relative to how much I save.
Right.
If you think about it, if you were to come to me in the beginning and you have your realtor business,
right,
you have your LLC and you're doing well, and I'm saying, hey, let's switch to an S corp, and now we're going to save you $10,000 in taxes this year,
right,
and then next year it's going to be a little bit more and a little bit more because that S corp is in there forever. So I've created an income stream for you that you did not have,
right,
and you only paid me my minimal fee,
right.
And it's a lot less than the $10,000 that I saved you.
Yeah,
and
exactly.
But you're getting that every single year.
So for an investor, I want you to hear that he said the word income or the phrase income stream. That's like buying another several rentals. I mean, if it's $5,000 a year in taxes, I mean in tax savings, that's an income stream. That's like a whole other rental,
right?
And you haven't bought anything. It's just you've created an income stream. So I'm a firm believer in paying a professional who's going to do it a lot better than I am. I used to be a DIYer. That's how I was raised to think, but I've converted from that. I don't do that anymore.
Well, I mean, the same way with me. It's like the first flip that my wife and I bought, we're going to do it ourselves, which we did.
Yeah.
It took longer, cost more,
it's terrible. Yeah.
Everything. It's like, oh man, it's like I should have just paid the contractor to come in and knock it out and have it done in 90 days.
Yeah.
So now I hire contractors.
Yeah. Mm-hmm.
You know, I even have property managers. It's like I decided at some point, I don't need to be doing this.
Exactly.
So they're worth every dime I pay them.
Mm-hmm.
Now, you know, I've been lucky and had really good property managers so far. So,
yeah.
But yes, you find the best people that you can get for what it is you need, and they become your advisors, or they become people you count on. They're part of your team.
Right.
Right.
Mm-hmm.
And so you're building a team in life anyway.
Right.
And so you find those people, and it's like they're better at it than you. That's going to save you money. And then you can use your time for highest and best use.
Yeah, and that's exactly right. I tell people, you focus on your magic superpower and let them focus on their magic superpower and use it on your behalf. I mean, Bob's magic superpower, obviously, if y'all have been listening, is saving real estate investors tax money. Right. And so that's a great magic superpower. I don't wish I had it because I can focus on my own magic superpower and let Bob do his magic on my behalf, so to speak. So I'm a firm believer in that. So I'm really excited, Bob, to get into your book and for our listeners to hear a little bit more about your book. We're going to have you on another episode in the future, and thank you for sponsoring this podcast today.
Thanks, Will.
Yeah, we're excited. Can you tell our audience how they can contact you if they want to get some more advice from you?
Sure. Our company website is nortonaccountingservices.com. There's also the realestatetaxpro.com, which basically focuses on the book, but I think there's a way to schedule a consultation through that. The company phone number is 985-690-4498. And then, of course, info@nortonaccountingservices.com.
What about if they want a copy of your book? You said it's
the book is available on Amazon.
Okay.
So, or you can contact me and buy the book directly from me.
Okay.
And on Amazon, you can get the Kindle version or you can get the paperback version.
Well, as you've heard today, folks, Bob Norton, Norton Accounting Services, thank you so much for sponsoring today's episode. He is truly the real estate tax pro. He focuses on real estate investors, has clients with properties in over 48 states, which was a cool fact I learned today. And he's been a valuable resource to me. I'd highly recommend you talking with him. And cheers to your wealth building journey. I'd like to thank, again, our title sponsor, First Access Mortgage. They've been Louisiana's first choice mortgage company for 21 years, and we're excited to be partnered with them. If you have a first home need, vacation home, short-term rental, refinance, whatever you need, they're truly a resource. So thank you for listening today to our podcast. This is the Will Frederick Podcast, where we talk about real estate, wealth building, money, and life. Thanks for joining us today.